Question 1. Which of the following statements most accurately describes the primary market in securities? A. It is where previously issued securities are traded among investors. B. It is where new issues of securities are sold to the public for the first time. C. It is the over-the-counter market where unlisted securities are traded. D. It is an exchange market where listed securities are bought and sold. Answer: B. It is where new issues of securities are sold to the public for the first time. The primary market is the segment of the capital markets where new securities are issued and sold to investors for the first time. This includes initial public offerings, IPOs, and subsequent primary offerings, SPOs. In this market, the issuing company receives the proceeds from the sale of the securities. This contrasts with the secondary market, where existing securities are traded between investors, and the issuer does not receive any proceeds. Question 2. A prospectus is required to be delivered to investors for which type of offering? A. A private placement of securities. B. An initial public offering, IPO, of non-exempt securities. C. A sale of municipal bonds by a state government. D. An offering of U.S. Treasury securities. Answer: B. An initial public offering, IPO, of non-exempt securities. The Securities Act of 1933 requires that all non-exempt securities offerings be registered with the SEC and that a prospectus be delivered to potential investors. This document provides material information about the issuer and the offering to help investors make informed decisions. Private placements, municipal bonds, and U.S. Treasury securities are typically exempt from the full registration and prospectus requirements, though other disclosure documents may be used. Question 3. Which of the following entities is primarily responsible for maintaining order and fairness on a securities exchange and enforcing FINRA rules for its members? A. The Securities and Exchange Commission, SAC. B. The Federal Reserve Board, FRB. C. The Municipal Securities Rulemaking Board, MSRB. D. The Financial Industry Regulatory Authority, FINRA. Answer: D. The Financial Industry Regulatory Authority, FINRA. FINRA is the largest independent regulator for all securities firms doing business in the United States, responsible for overseeing broker-dealers and their registered representatives. It writes and enforces the rules governing broker-dealers, conducts examinations, and disciplines members. While the SEC is the ultimate authority for federal securities laws, FINRA operates under its oversight as a self-regulatory organization, SRO, to maintain fair and orderly markets and protect investors. Question 4. A company issues 10-year bonds that are callable. Which of the following risks is most relevant to an investor holding these bonds? A. Liquidity risk. B. Reinvestment risk. C. Credit risk. D. Inflation risk. Answer: B. Reinvestment risk. Callable bonds allow the issuer to redeem the bond before its scheduled maturity date, typically when interest rates decline. If the issuer calls the bond, the investor receives their principal back and must then reinvest it, likely at lower prevailing interest rates. This inability to reinvest at the original higher rate is known as reinvestment risk. Understanding callable features is vital for bond investors, as it impacts potential returns and income stability. Question 5. Which type of investment company typically issues only common shares and trades on exchanges, often at a premium or discount to its net asset value, NAV? A. Open-end management company, mutual fundee. B. Unit Investment Trust, UIT. C. Closed-end management company. D. Exchange-traded fund, ETF. Answer: C. Closed-end management company. A closed-end management company issues a fixed number of shares through an IPO, which then trade on secondary markets like stock exchanges. Unlike mutual funds, their shares can trade at prices above, premium, or below, discount, their net asset value, NAV, because their market price is determined by supply and demand. This structure provides liquidity to investors through trading on exchanges, but introduces market price volatility relative to NAV. Question 6. An investor owns 100 shares of common stock. If the company declares a 2-for-1 stock split, how will the investor's position change? A. The investor will own 50 shares, and the price per share will double. B. The investor will own 200 shares, and the price per share will be halved. C. The investor will own 100 shares, and the company will issue a dividend. D. The investor will own 200 shares, and the price per share will remain the same. Answer, B. The investor will own 200 shares, and the price per share will be halved. In a 2-for-1 stock split, the number of shares an investor owns doubles, while the price per share is proportionally reduced by half. For example, 100 shares at $50 per share would become 200 shares at $25 per share. The total value of the investor's position remains unchanged immediately after the split. Stock splits are often used to make a company's stock more accessible to a broader range of investors by lowering its per share price. Question 7. Which of the following is a primary characteristic of a money market instrument? A. Long-term maturity, typically over 1 year. B. High default risk, compensated by high yields. C. Highly liquid, short-term debt security. D. Issued primarily by corporations to raise equity capital. Answer, C. Highly liquid, short-term debt security. Money market instruments are short-term, highly liquid debt securities with maturities of 1 year or less. Examples include treasury bills, commercial paper, and certificates of deposit, CDs. These instruments are generally considered low risk and are used by governments, corporations, and banks for short-term borrowing and lending. Investors seeking safety and liquidity often include money market instruments in their portfolios. Question 8. An investor purchasing a municipal general obligation, GO, bond is primarily concerned with the issuers. A. Ability to generate revenue from specific projects. B. Overall creditworthiness and taxing power. C. Profitability and market share in its industry. D. Ability to repay debt through federal subsidies. Answer, B. Overall creditworthiness and taxing power. General obligation, GO, bonds are backed by the full faith and credit of the issuing municipality, which means they are supported by the issuer's taxing power. Investors in GO bonds assess the municipality's overall financial health, debt burden, and ability to raise taxes to cover debt service. This contrasts with revenue bonds, which are backed by the specific revenues generated by the project they finance. Understanding the backing of a municipal bond is crucial for assessing its credit risk. Question 9. Which of the following federal agencies insures customer deposits in banks up to a specified limit? A. Securities Investor Protection Corporation, SIC. B. Federal Reserve Board, FRB. C. Federal Deposit Insurance Corporation, FDIC. D. Securities and Exchange Commission, SAC. Answer, C. Federal Deposit Insurance Corporation, FDIC. The Federal Deposit Insurance Corporation, FDIC, is an independent agency of the United States government that protects depositors of insured banks and savings associations. It insures deposits up to $250,000 per depositor, per insured bank, for each account ownership category. This protection is vital for maintaining public confidence in the banking system, ensuring that customers' cash deposits are safe even if a bank fails. It's important to distinguish FDIC insurance from SIPC, which protects securities customers in case of a broker-dealer's failure. Question 10. A customer who sells a put option believes the underlying stock's price will A. Increase or stay the same. B. Decrease significantly. C. Increase significantly. D. Stay exactly the same. Answer. A. Increase or stay the same. A seller, writer, of a put option grants the buyer the right to sell the underlying stock at a specified strike price. In return, the seller receives a premium. The seller profits if the stock price remains above the strike price or rises, allowing the option to expire worthless. Conversely, the seller incurs a loss if the stock price falls below the strike price, forcing them to buy the stock at the higher strike price. Therefore, a put seller is bullish or neutral on the underlying stock. Question 11. Which market participant acts as an intermediary, buying and selling securities for its own account and assuming risk? A. Broker. B. Agent. C. Investment advisor. D. Dealer. Answer. D. Dealer. A dealer, or principal, acts for its own account, buying securities into its inventory from customers and selling securities from its inventory to customers. When acting as a dealer, the firm assumes market risk and profits from the bid-ask spread. In contrast, a broker, or agent, executes orders on behalf of customers without taking ownership of the securities, earning a commission for their services. Understanding this distinction is fundamental to how firms operate in the securities markets. Question 12. What is the primary purpose of a red herring prospectus? A. To confirm the final price of an IPO. B. To solicit indications of interest from investors during the cooling-off period. C. To announce the effective date of a new offering. D. To provide a simplified, unaudited summary of a company's financial statements. Answer. B. To solicit indications of interest from investors during the cooling-off period. A red herring prospectus, also known as a preliminary prospectus, is issued during the cooling-off period of a new securities offering. Its purpose is to gather indications of interest from potential investors without actually confirming orders or selling the securities. It contains most of the information found in the final prospectus, but it omits the final offering price and the effective date. The red legend on the cover indicates that the registration statement is not yet effective. Question 13. An investor concerned about interest rate risk would be most affected by changes in interest rates impacting the value of their A. Common stocks. B. Fixed income bonds. C. Money market funds. D. Real estate investment trusts, REITs. Answer. B. Fixed income bonds. Fixed income bonds are most susceptible to interest rate risk, which is the risk that changes in market interest rates will negatively impact the value of a bond. When interest rates rise, newly issued bonds offer higher yields, making existing bonds with lower yields less attractive, thus decreasing their market value. Conversely, when interest rates fall, existing bonds with higher yields become more attractive. Longer duration bonds are generally more sensitive to interest rate changes. Common stocks, money market funds, and REITs are influenced by interest rates but not in the same direct inverse relationship as fixed income bonds. Question 14. Which term describes the process by which a broker-dealer assists a company in selling its newly issued securities to the public? A. Arbitrage. B. Market making. C. Underwriting. D. Portfolio management. Answer. C. Underwriting. Underwriting is the process by which investment banks, broker-dealers, help companies issue new securities to the public. The underwriter agrees to purchase the securities from the issuer and then resell them to investors, often assuming the risk of unsold shares. This critical function facilitates capital formation for businesses and governments. Understanding the underwriting process is key to comprehending how new securities are brought to market. Question 15. A tombstone ad typically includes A. A detailed analysis of the company's financial performance. B. The names of the issuer, the security, and the syndicate members. C. A recommendation to buy the security. D. The final offering price and interest rate. Answer, B. The names of the issuer, the security, and the syndicate members. A tombstone ad is a simple advertisement published by underwriters to announce a new securities offering. It typically includes the issuer's name, the type and amount of the security being offered, and the names of the syndicate members involved in the underwriting. Importantly, it is not an offer to sell or a solicitation to buy, and it generally does not include the offering price or detailed financial analysis. Its purpose is purely informational, indicating where a prospectus can be obtained. Question 16. The Securities Investor Protection Corporation, SIC, protects customer accounts against A. Losses due to market fluctuations. B. Fraudulent activities by a broker-dealer. C. Bankruptcy of a broker-dealer. D. Losses from unauthorized trading. Answer, C. Bankruptcy of a broker-dealer. SIPC protects customers of member broker-dealers if the broker-dealer fails financially. It covers up to $500,000 per separate customer, with a $250,000 limit for cash. SIPC does not protect against market losses, fraud, which is covered by other laws and regulations, or unauthorized trading, which falls under firm liability and regulatory action. Its primary role is to restore customer cash and securities held by the failed brokerage firm. Question 17. What is the primary difference between common stock and preferred stock regarding voting rights? A. Both common and preferred stockholders have equal voting rights. B. Common stockholders typically have voting rights, while preferred stockholders generally do not. C. Preferred stockholders have voting rights in proportion to their dividend yield. D. Only preferred stockholders have voting rights, especially on major corporate decisions. Answer, B. Common stockholders typically have voting rights, while preferred stockholders generally do not. Common stockholders typically have voting rights, allowing them to influence corporate governance through electing the board of directors and approving major company decisions. In contrast, preferred stockholders generally do not have voting rights. However, preferred stock usually offers a fixed dividend payment and has priority over common stock in receiving dividends and in claims on assets upon liquidation. This trade-off between voting rights and dividend priority is a key distinction between the two equity types. Question 18. Which of the following is an example of systematic risk? A. A company's new product failing to gain market acceptance. B. A labor strike at a major manufacturing firm. C. A recession impacting the entire stock market. D. A lawsuit filed against a specific pharmaceutical company. Answer, C. A recession impacting the entire stock market. Systematic risk, also known as market risk, is the risk that affects the entire market or a large segment of it, and it cannot be diversified away. Examples include economic recessions, wars, or significant interest rate changes that impact all investments to some degree. The other options describe unsystematic risk, which is specific to a particular company or industry and can be reduced through diversification. Understanding this distinction helps investors manage portfolio risk effectively. Question 19. A real estate investment trust, REIT, is an investment vehicle that primarily invests in A. Mortgage-backed securities only. B. Real estate and real estate-related assets. C. Publicly traded stocks and bonds of various industries. D. Commodities futures and options. Answer, B. Real estate and real estate-related assets. A real estate investment trust, REIT, is a company that owns, operates, or finances income-producing real estate. REITs allow individuals to invest in large-scale income-producing real estate without directly buying, managing, or financing property. To qualify as a REIT, a company must distribute at least 90% of its taxable income to shareholders annually. This structure offers investors exposure to real estate and typically provides high dividend yields, making them an attractive income investment. Question 20. The third market refers to A. Exchange-listed securities traded over the counter. B. Unlisted securities traded on the OTC Bulletin Board. C. Foreign securities traded in U.S. markets. D. Institutional investors trading directly with each other. Answer. A. Exchange-listed securities traded over the counter. The third market involves the trading of exchange-listed securities in the over-the-counter, OTC, market. This allows institutional investors to trade large blocks of listed stocks away from the exchange floor, often to achieve better prices or reduce transaction costs. It's an important part of the secondary market, demonstrating that not all trading of listed securities occurs on the traditional exchanges. The fourth market, in contrast, involves direct trading between institutional investors without a broker-dealer. Question 21. Which of the following describes the role of a transfer agent? A. Executes buy and sell orders for customers. B. Maintains records of stock and bond owners, and issues new certificates. C. Provides investment advice for a fee. D. Acts as a custodian for client assets. Answer, B. Maintains records of stock and bond owners, and issues new certificates. A transfer agent is responsible for keeping track of the ownership of a company's stocks and bonds. Their duties include issuing and canceling certificates to reflect changes in ownership, handling dividend and interest payments, and managing shareholder mailings. They ensure accurate record-keeping for the issuer and its shareholders. This role is distinct from that of a broker-dealer, executing orders, an investment advisor, providing advice, or a custodian, holding assets. Question 22. When comparing two bonds with the same coupon rate and maturity, the bond trading at a discount will have a yield to maturity, YTM. A. Equal to its coupon rate. B. Lower than its coupon rate. C. Higher than its coupon rate. D. Impossible to determine without more information. Answer, C. Higher than its coupon rate. If a bond is trading at a discount, below its par value, its yield to maturity, YTM, will be higher than its coupon rate. This is because the investor will not only receive the regular interest payments but also a capital gain when the bond matures at par. Conversely, a bond trading at a premium will have a YTM lower than its coupon rate. This relationship is a fundamental concept for bond investors when evaluating potential returns. Question 23. Which of the following is not typically a characteristic of a unit investment trust, UIT? A. A fixed portfolio of securities. B. Actively managed portfolio. C. Issues redeemable units. D. No board of directors. Answer, B. Actively managed portfolio. A unit investment trust, UIT, is known for its fixed, unmanaged portfolio of securities, which is established at inception and generally remains unchanged. Unlike mutual funds, UITs are not actively managed. There is no portfolio manager making ongoing buy-sell decisions. They issue redeemable units, and they do not have a board of directors, which helps keep operating expenses low. Their static nature provides predictability but lacks flexibility to adapt to market changes. Question 24. The ex-dividend date for a stock is the date on which a. The dividend is officially declared by the board of directors. b. The company establishes its list of shareholders entitled to receive the dividend. c. Shares begin to trade without the right to receive the upcoming dividend. d. The dividend payment is actually distributed to shareholders. Answer: C. Shares begin to trade without the right to receive the upcoming dividend. The ex-dividend date is the first day a stock trades without the right to its next dividend payment. If an investor buys a stock on or after the ex-dividend date, they will not receive the upcoming dividend. This date is determined by FINRA or the exchange and is usually one business day before the record date. Understanding the ex-dividend date is crucial for investors who buy or sell stocks around dividend announcements, as it directly impacts who receives the dividend. Question 25. What is the primary role of the Options Clearing Corporation, OC? A. Regulates the options markets and ensures fair trading practices. B. Issues, guarantees, and clears all listed options contracts. C. Provides investment advice specifically for options traders. D. Acts as a marketplace for options trading. Answer: B. Issues, guarantees, and clears all listed options contracts. The Options Clearing Corporation, OC, is the primary clearing agency for equity options, foreign currency options, and options on stock indexes and interest rates. It standardizes, guarantees, and clears listed options contracts, becoming the buyer to every seller and the seller to every buyer. This guarantee function significantly reduces counterparty risk for options traders. The OCC ensures the integrity and stability of the options market, but it does not regulate the market, provide advice, or act as a trading venue itself. Question 26. A market order is an order to buy or sell a security. A. At a specified price or better. B. Immediately at the best available current price. C. Only if the price reaches a certain level. D. At the end of the trading day's closing price. Answer: B. Immediately at the best available current price. A market order is an instruction to buy or sell a security immediately at the best available price in the market. It prioritizes execution over price, meaning it will be filled as quickly as possible, often at the prevailing bid, for selling, or ask, for buying, price. This type of order is used when an investor wants to ensure their trade is completed without delay, though the exact price is not guaranteed. In contrast, a limit order specifies a maximum or minimum price. Question 27. Which risk is most accurately described as the potential for an investment to lose value due to factors specific to a particular company or industry? A. Market risk. B. Systematic risk. C. Unsystematic risk. D. Inflation risk. Answer: C. Unsystematic risk. Unsystematic risk, also known as specific or company-specific risk, is the potential for an investment to lose value due to factors unique to a particular company, industry, or asset. Examples include poor management decisions, a product recall, or a labor strike. This type of risk can be reduced through diversification. In contrast, market risk, systematic risk, affects the entire market and cannot be diversified away. Question 28. What is the role of a prime broker? A. To provide research and investment banking services to retail clients. B. To offer a bundled package of services, including custody, clearing, and financing, to hedge funds and other institutional clients. C. To manage mutual fund portfolios for individual investors. D. To execute trades exclusively for pension funds. Answer, B. To offer a bundled package of services, including custody, clearing, and financing, to hedge funds and other institutional clients. A prime broker offers a comprehensive suite of services to institutional clients, particularly hedge funds, allowing them to consolidate their trading activities with multiple executing brokers while maintaining a single custodial account. These services typically include securities lending, margin financing, custody, clearing, and operational support. This arrangement streamlines operations and provides cost efficiencies for complex institutional strategies. Understanding prime brokerage is important for appreciating the infrastructure supporting large-scale investment operations. Question 29. Which of the following is an example of a capital market instrument? A. A 90-day commercial paper. B. A treasury bill, T-bill. C. A 30-year corporate bond. D. A negotiable certificate of deposit, D, with a 6-month maturity. Answer, C. A 30-year corporate bond. Capital market instruments are long-term debt or equity securities with maturities typically greater than 1 year. A 30-year corporate bond fits this description, as it represents long-term borrowing by a corporation. Commercial paper, treasury bills, and short-term certificates of deposit are examples of money market instruments, characterized by their short-term maturity, 1 year or less, and high liquidity. Understanding the distinction between money and capital markets is crucial for classifying financial instruments. Question 30. The Securities Act of 1933 primarily regulates A. The secondary trading of securities. B. The issuance of new securities in the primary market. C. Broker-dealers and their employees. D. Investment companies. Answer, B. The issuance of new securities in the primary market. The Securities Act of 1933, often called the Truth in Securities Law, primarily regulates the issuance of new securities in the primary market. Its main objective is to ensure that investors receive full and fair disclosure of material information concerning new public offerings of securities. This is achieved through registration requirements and the mandated delivery of a prospectus. The Act of 1934, conversely, governs secondary market trading and broker-dealer operations. Question 31. Inflation risk is best described as the risk that A. An investment's value will decrease due to rising interest rates. B. A company's profits will be negatively impacted by industry-specific factors. C. The purchasing power of an investment's returns will decline over time due to rising prices. D. An investor will be unable to sell an investment quickly without significant loss. Answer, C. The purchasing power of an investment's returns will decline over time due to rising prices. Inflation risk, also known as purchasing power risk, is the risk that the returns from an investment will not keep pace with inflation, thus eroding the real purchasing power of an investor's money over time. Even if an investment provides a positive nominal return, high inflation can lead to a negative real return. This risk is particularly relevant for long-term investors and those holding fixed-income securities. Understanding inflation risk helps investors select appropriate assets to preserve their wealth. Question 32. Which of the following describes the role of the Depository Trust and Clearing Corporation, DTC? A. Regulates all securities firms and their associated persons. B. Provides deposit insurance for bank accounts. C. Offers centralized clearing, settlement, and information services for financial transactions. D. Manages the federal funds rate and monetary policy. Answer, C. Offers centralized clearing, settlement, and information services for financial transactions. The DTCC, Depository Trust and Clearing Corporation, is a critical component of the financial infrastructure, providing centralized clearing, settlement, and information services for virtually all U.S. securities transactions. Its role is to reduce risk and provide efficiency by processing trades between broker-dealers, minimizing physical certificate movements, and ensuring the timely and accurate transfer of securities and funds. This significantly reduces systemic risk in the financial markets. The DTCC does not regulate firms, insure bank deposits, or manage monetary policy. Question 33. A broker-dealer acting in an agency capacity is: A. Executing trades on behalf of clients and charging a commission. B. Taking the opposite side of a client's trade, buying from or selling to its own inventory. C. Providing investment advice for a fee. D. Acting as an underwriter for a new securities issue without taking on risk. Answer: A. Executing trades on behalf of clients and charging a commission. When a broker-dealer acts in an agency capacity, it is executing trades on behalf of customers and earns a commission for facilitating the transaction. In this role, the firm acts as a broker and does not take ownership of the securities, thus not assuming market risk. This contrasts with a principal capacity, where the firm acts as a dealer and buys or sells from its own inventory. Understanding these roles is fundamental to how broker-dealers operate and charge for their services. Question 34. Which type of bond offers investors potentially tax-free interest income at the federal level, and sometimes at the state and local levels too? A. Corporate bonds. B. U.S. Treasury bonds. C. Municipal bonds. D. Mortgage-backed securities. Answer, C. Municipal bonds. Municipal bonds, issued by state and local governments, are a unique type of debt security because their interest income is typically exempt from federal income tax. Additionally, if the bondholder resides in the issuing municipality, the interest may also be exempt from state and local taxes, making them triple tax exempt. This tax advantage is a primary reason investors, particularly those in high tax brackets, choose municipal bonds, despite often having lower nominal yields than taxable bonds. Corporate bonds and treasury bonds have different tax treatments. Question 35. The process of diversification in a portfolio aims to primarily reduce which type of risk? A. Systematic risk. B. Market risk. C. Unsystematic risk. D. Inflation risk. Answer, C. Unsystematic risk. Diversification is an investment strategy designed to reduce unsystematic risk, also known as specific or company-specific risk. By investing in a variety of assets across different industries, geographies, and asset classes, an investor can mitigate the impact of a poor performance by any single investment. While diversification cannot eliminate systematic risk, market risk, it is a powerful tool for managing risks unique to individual securities or sectors. A well-diversified portfolio aims to achieve smoother returns over time.